Balance your trading strategy by adding futures. CME Group helps you manage risk and capture opportunities in all market environments. Capitalize on around-the-clock access to highly liquid global futures and options market across all major asset classes. Just visit your online broker and get started. Plug into valuable educational materials and trading tools and see what adding futures can do for you at cmegroup.com/on-the-tape.
iConnections is the world's largest capital introduction platform in the alternative investment industry. They bring the asset management community together through a membership platform that lets allocators and managers meet and connect both physically and virtually. Over 3,000 allocators and 600 managers are part of the iConnections community, overseeing nearly $48 trillion and $16 trillion in assets, respectively. iConnections first came to our attention in 2020 during the first wave of the pandemic. That's when their first event, Funds for Food, became the largest virtual cap intro event in history. To date, they've donated nearly $2.5 million to charities. They are also the people behind the alternative investment industry's largest and most exciting in-person events. To find out more about iConnections events and members-only platform, visit iConnections.io.
In the continuing theme of you asked for it, you got it. Well, we brought in Tom Lee to talk his bullish thesis on the broader market. Now we're bringing in Ben Kallo, noted Tesla bull of RW Baird, for this bonus episode of On the Tape with Dan Nathan, Danny Moses, and yours truly.
We brought the big guns in because we have an old friend of ours. His name is Ben Kallo. He covers sustainable energy and mobility over at RW Baird. He has been a long-time bull on Tesla. He also covers the space and has some big, broad thesis in the space as it relates to sustainable energy. So we're going to hit some other names other than Tesla. But Ben, welcome back to our Risk Media podcast network.
Well, thank you, Dan. And thank you, Guy, and thank you, Danny. Happy to be here after a long time, and good to see all of you guys.
All right, man. Well, let's get into it. Tesla held this investor day a couple weeks ago. It was widely anticipated. It started a little bit late for whatever reasons. I think a lot of investors were really excited about the potential for maybe some new vehicle announcements. They didn't get it. They got some big sheets that had something, maybe metal underneath them that maybe moves at some way, shape, or form, but they didn't get that. They did have a whole host of the executive team with Elon. There was a lot of big ideas about what they're going to do within the sustainable energy space. So it looked like something broadening it out away from EVs a little bit. We just wanted to kind of get your impressions there. Were you disappointed? I know that you reiterated your outperform rating. Did you get a little bit of what you wanted? And, did it make the story a bit clearer, especially at a time where I think a lot of investors are kind of left scratching their heads with a whole host of issues as it relates to just, valuation, where the stock has been and where it's going?
First of all, living in San Francisco for a long time, being able to tour the NUMMI facility maybe 50 plus times, and that's the Fremont facility that Tesla bought from NUMMI, and seeing the difference of the Austin factory. I haven't been to Berlin. I haven't been to Shanghai. It's a remarkable difference in how they built the factory from the ground up versus the factory they bought from NUMMI and had to kind of squeeze into it, if we put it that way, which is not the most efficient thing. And the thing about Austin, I think, that is overlooked is that it should be the highest margin factory, and that's going to be here in the United States, obviously in Texas, even higher margin than Austin. This is kind of how they've learned from Fremont and the Gigafactory 1 in Nevada, and moved those learnings to Shanghai, then to Berlin, then to Austin. And I think that as we toured the factory, the big theme was reducing costs, increasing efficiency, and I think that that will be replicated. They did announce the factory in Mexico. Going into it, you kind of danged if you do and danged if you don't by showing a new vehicle. Musk gets, probably for right, a lot of flack about not bringing, like the Cybertruck, for example. it was announced 4 years ago, and they're going to start production on low volumes at the second half of this year. And so the fact that they didn't, showcase a new car, I can understand why, especially in addition to having the time to bring it to production, but also maybe that chips off some demand too. And, that's a big question, as we entered into this year about demand, especially with the economic backdrop that we have.
Ben, were you expecting kind of the $150 to $175 billion guidance in CapEx? I'm not sure how much of that is obviously in your model over the next kind of 6 or 7 years. I realize you probably don't model out that far, but more importantly, just seems to me when you see numbers like that, from a valuation perspective, it lends itself more to an industrial, right? To an auto manufacturer, in my opinion, more than kind of this robo-taxi kind of tech dream. So how do you kind of marry that? They can't finance this, obviously, from just profit. So how do you expect them to kind of come up with this money over that 6-7 year period of time?
A couple things. And it's a great question, Danny. They're spending, call it $7 billion in CapEx. Plus, call it just around about $3 billion in R&D. So $10 billion. This is a big topic about capital allocation because Musk has said, we can't spend capital any faster, outside of doing acquisitions. Still, free cash flow positive in 22. Balance sheet with $22 billion on it and not really any debt. So they're in a good shape with that. Can they finance it from just the balance sheet? I think so. They can go out to the debt markets if needed. In the longer term, we did get an announcement from VW just in the last 24, 48 hours about their plans to spend a roundabout number of $178 billion as well. I look at the two companies, I wonder how they finance it more than how Tesla finances it.
The cult of personality around Elon Musk, and by the way, welcome. You are the original BK, by the way, just for clarity's sake. But the cult of personality around him is obviously significant. Through the lens that I look at, it seems as though he's toned down things just a bit. I would submit, obviously, he's still incredibly important to Tesla. But is he as important today as he was, let's say, 5 years ago? Or would Tesla be able to move on if, in fact, he stepped down or he made moves within the C-suite?
Key person risk, key man risk, number one thing. I was watching a video of Danny on Fast Money with you guys last year, and he was short the stock. And it was a good call, Danny. You talked about the brand being so important. And I remember writing a report back in 2013 about the brand. And I think that what we've seen from some surveys recently is that it hasn't been disrupted, but he creates a significant noise with Twitter, with espousing his political views. I think at the end of the day, consumers are going to spend $45,000, $55,000, $60,000, $100,000 on a car. Are going to buy the best car that they're going to buy, regardless of the person's political views. But he is still the number one person there. And there are people that, invest because of him. I think that we got some churn in retail investors from them not liking, his political views. And he probably, lost some customers because of that. Probably also gained some customers from that as well. It's above my pay grade to tell him to be quiet. The success he's had across, several different companies. I think that one thing at Investor Day that was showcased is there are other people there. He doesn't like that format of talking to investors. It looked like he had some back pain or something when I was sitting up there looking at him. And it was interesting that he did a conference at Morgan Stanley, a couple days later, mostly about Twitter. I imagine that's someone got him to do that because they helped finance the Twitter buyout. It was an interesting 45 minutes with him at the Morgan Stanley, but at Investor Day, it's not really his venue or with investors. And sometimes the questions annoy him, but that's part of being a public company, I think.
Let's bring it to the stock for a second here. Okay, so 560 billion market cap company. It was 1.2 trillion at its highs in late 2021 before Elon started selling stock fairly aggressively all throughout last year, obviously to finance bit of that Twitter deal. When I look at this story, right, and it really was about margin expansion, especially relative to its auto peers. A lot of investors willing to assign a valuation to a company that they said is not a car company. And it was also a margin story, right? And so when you think about their margins relative to their peers, when I look at 2023 consensus estimates on FactSet, I'm looking at 25% expected sales growth with earnings per share expected to be down a couple percent or so. When I think about the margin impact from 25.5 or so last year in 2022 to expected 22 or so this year, I say to myself, okay, they've had two meaningful price cuts on some very important, lines of their cars, right? We know that there's issues as far as there's been shutdowns in Shanghai and who knows if we have those sorts of things again. I'm just curious, what would the stock, in your opinion, again, you rate the stock and outperform, but if there was another round of price cuts, and make no mistake about it, what's going on with this Silicon Valley Bank? We just talked a little bit about from a brand standpoint. You just said that you think people will continue to pay 45, 80, 135, whatever it is, the high-end Plaid, for the best EV. I'm not sure that's their cars anymore. And I'm not sure that the Silicon Valley folk, who have been huge supporters of the story, but also of the product, are going to be there the way they were in the last couple of years. So I'm just curious. Again, I know this is a long-winded way of asking. It really feels like these EPS expected declines this year and margin declines, this could be just getting started a little bit in what could be a tough year, because everything that's gone on, in my opinion, over the last, call it few months, really speaks to a recession that's coming here and possibly abroad in the next 6 to 9 months.
Going into 23, as the stock came down, the street just revised their numbers. I did. We slashed them. We cut volumes, we cut margin. Obviously, that leads to cuts in earnings. We have earnings up by 2 pennies from 407 to 409. I think then we got into the first of the year, and so we started China, 2 cuts there, massive cut in the U.S. on prices. Now this was coming after the last 2 years. All they did was raise prices. They did it several times. Not sure it got as much attention as the price cuts. Now, what we've seen, the sentiment or the narrative, even from my sell-side brethren, have sells, underperforms in the stock, change the message from, oh gosh, there's a demand issue, to when you have the industry-leading operating margins out there, highest in the industry, you can cut price and you can have this price war. And so that changed the tone of what Tesla is doing. Now, to the financials, what's happened since then is we've seen an uptick in volume purchases across, I think, all regions. China, numbers coming out there for February look very good. The Y was the leading electric vehicle by sales. The 3 was just behind BYD vehicle. I think that what we've seen out of Europe, very good sales. And in the U.S., as the Inflation Reduction Act and, the credit for consumers is kicked in, that sales have ticked up here. And so we enter the year with all of us slashing numbers. It got calibrated. Now, I think the numbers, revisions are likely going to the upside here. And a couple things on margin that will help out. What, Tesla says publicly is that everything outside of lithium, they've seen deflation in, number one. Number two, you're going to have the factories, the 3 factories. And I say 3. So I say Berlin, Austin, and then their cell factory, those becoming a tailwind instead of a headwind. So becoming margin accretive. And that will start happening in the second quarter and in the back half of the year. You do have full self-driving. We can talk about that at length, probably too long for you guys to want to listen to me. But, that kicking in the way that they recognize that revenue, which should be a margin boost as well. And then you do have improvements in just overall manufacturing, the way that they do die casting, the injection molding, saves on, the number of welds you need and how they, are going to do the difference in their battery packs, saving, and it's kind of taking out costs everywhere. And I think that was a theme at the Analyst Day, is getting to this scale of 20 million cars, what you have to do in terms of supply chain as well as reducing costs overall in the vehicle. And so, Q1 is going to have, you're going to get a margin hit because of those price cuts. But I do think that numbers are probably calibrated too low for the whole year.
20 million cars. There's never been a car company in the history of the automobile business that's delivered 20 million cars in a year. What gives you confidence by 2030, let alone 2040, this company will ever be able to do that? Because again, the history of Tesla, since I've been following it and you've been covering it obviously much more closely than I, has been massive overpromising and under-delivering. And when we just talked about, back to Danny's question about working in that CapEx, on the other side of that versus just very, very lofty projections, the assumption that the incumbents, who are the ones that actually deliver the bulk of the global auto share right now and have a huge vested interest, right, in defending their market share as everybody moves to EVs. I feel like when I look at this story, I feel like Tesla has so much more to lose actually than the incumbents when you think about it. When they give their targets about moving their production to primarily EV by a certain time, right, versus Tesla overpromising like something greater than the entire auto market delivers in a year right now, I feel like they have the most to lose, not the incumbents. And I think that's what the market is getting wrong. That's my personal view. I'm just curious what you think about that, because you and your sell side research brethren, do you guys massively discount those expectations for deliveries?
We do. And just back on valuation, because, a lot of times, I get this, it's a $572 billion market cap company. But just, let's talk about just on a PE level. So my number for 26 is $8.90. Let's say that I'm conservative, like you said, on volumes. This is one of the things that I think you should buy the stock for too. Is I think volumes are going to be revised upwards. The street has come in too aggressively to the downside. And, they talk about a 50% growth rate, over time each year, CAGR. But let's just say it's $10, so it's trading at 18 times. It's growing top line. No other auto company, Ferrari maybe, growing top line, better margins than any auto company, except for maybe Ferrari. And they have all this other stuff going on, but growing very rapidly. It will be more important as this year and next year too. It's going to start reaching over 10%. I do think that you have a situation where 20 million units, no one believes that, and so I don't know if that's not priced into the stock at all. But I do think that they've given a better pathway than anyone else that we're talking about. I don't want to pick on anyone, but you name it, and we're talking about 50,000, 100,000, 150,000 units outside of the Chinese manufacturers and some others. And so one of the things that we give, the Musk discount of 2 or 3 years, I don't think that we rewound when I first met you guys 10 years ago, if we would have thought we're trying to get to 2 million cars this year.
Introducing event contracts from CME Group for individual investors who want a new, less complex way to trade some of the world's most recognized futures markets. They're smaller, lower cost, with predefined risk. Event contracts let you trade your views on daily up or down price moves in equities, gold, oil, and more. The markets you know and use every day. Take a position by choosing a side with event contracts from CME Group. Learn more at cmegroup.com/event contracts.
iConnections is the world's largest capital introduction platform in the alternative investment industry. They bring the asset management community together through a membership platform that lets allocators and managers meet and connect both physically and virtually. Over 3,000 allocators and 600 managers are part of the iConnections community, overseeing nearly $48 trillion and $16 trillion in assets, respectively. iConnections first came to our attention in 2020 during the first wave of the pandemic. That's when their first event, Funds for Food, became the largest virtual cap intro event in history. To date, they've donated nearly $2.5 million to charities. They are also the people behind the alternative investment industry's largest and most exciting in-person events. To find out more about iConnections events and members-only platform, visit iConnections.io.
What's up? Guy here. Did you know FactSet is the official data provider for risk reversal media? FactSet is the key to all of our analysis. It's not just charts. FactSet provides insight into the top headlines of the day, private markets, and sector-specific data. If you ever have issues, get help from their support team that is committed to your success. Visit FactSet.com to experience the power of FactSet and request a free trial and unlock access to the tools that matter most to you.
The faith in Musk, people give him benefit of the doubt. I mean, at this point, the people that still kind of believe in him, I guess, will always believe in him. But the comment you made on full self-driving, there is no full self-driving, obviously, and recall was just issued. And I'm not going to go into how they're going to have to account for that or at all. But I want to conjoin that with kind of the robotaxi promise and the comment that you made about price cutting. The whole idea, and it wasn't just Elon Musk, it was Cathie Wood as well, about we're going to have these robo-taxis, which obviously will depend on full self-driving, which means the value of your car will actually go higher, right? That's been kind of a theory. And that has kind of all unwound here to a degree. And so I just want to go back to that. And then my second question is just China risk in general. Forget about Volkswagen's intent to actually go after China market, right? Just the Chinese geopolitical risk as we see a very large American company in China.
Obviously very topical. I'm more meat and potato, take a look at me, than some of my brother and Cathie Wood are. So we don't include any robotaxi in our valuation. I think that it's interesting when you think about it that you can sell, you guys, being in New York, probably get into an Uber or a cab that's a Tesla. And, I often quiz these guys about, if they have, which did they buy, the Autopilot or full self-driving. I'm surprised, and this is all anecdotal, by the number of people that buy full self-driving. And we estimate it's about 18% of North America, people buying something for $15,000 or on a subscription basis. It's not full self-driving yet. Continues to progress. They continue to make changes. They made changes, where they had radar and cameras, and then they said, we don't need a radar, ripped out the radar, and now they're going back to having a radar. They've lost team members, they've replaced team members. And I think it's just interesting from an outside perspective that they're able to sell something to people that it's not full self-driving, but people buy it. So on China, it's a risk. They addressed it at Analyst Day. I think that what we saw them, with the announcement of the factory in Mexico, they don't want to put another factory in China yet. They're likely going to announce another factory somewhere else in Asia and not in China. And I think that if we've rewound a couple of years ago, Musk would say that they would have several factories in China by this time. And I think that this has slowed them down. And so it's something definitely we keep an eye on.
We've known each other a long time. Question for you. When did you start covering Tesla, the stock?
2011.
At $180 at current levels, and you've been pretty steadfast over that last 12 or so years. I mean, it's probably, a 15-bagger or so. And you've been on this story longer and probably smarter than anyone. Here's my question to you, though, and this is somewhat a snapshot of time. From October of 2021 into November, when the stock was north of $400, that moved down to 102-ish. Although we bounced along the way, was pretty painful. Understanding, though, over the course of its history, the stock has still done extraordinarily well. As an analyst, how do you navigate that? Michael Pachter, for years, was negative in Netflix, and the stock would just continue to move higher. His thesis wound up being correct. It took time. How do you deal with a move of that magnitude, understanding that fundamentally you have the story right, but the market is telling a much different one?
It's a good question. That's why I paused, because I think that, it puts a pit in my stomach. And I remember going from, before all the splits, from 280 to 170 and being on vacation. I'm just looking at, the stock every second of the day. And, remember, coming back to some fundamentals of what I know and things, how the new factories are margin accretive and, those fundamentals. But I think more importantly is, talking to clients, and I have the benefit of, incoming calls and what people are asking. And what was occurring during that time and is still occurring, I think still driving the stock prices. You have institutional clients that don't own it, and they've avoided it like the plague, and they're benchmarked against the S&P 500. And as the stock started dropping, my call volume started going up because they're basically short, synthetically short the stock. As they started sniffing around, I realized, how underowned it is. And now as the stock moves up, the people that didn't buy it and that were doing like Tesla 101s, and it's amazing that you do that after 10 years in this 500 billion plus market cap company. But the fact that you're still doing 101s on this, and now I think there's the FOMO, that's the generation below me, fear of missing out. But people trying that didn't buy it, to cover in their benchmark, that are still trying to chase it and pick their spots. And so it being underowned, I think balance sheet, and actually living through, the 420 funding secured and Elon, calling the guy a pedo, all of that stuff, as painful as it was, it helped me learn to kind of tune out some of the noise.
Well, it's funny, from where we sit, and again, Guy and myself on Fast Money, and Danny and Guy and myself doing the pods, it's a battle that's going on. We see it. We see it in our tweets. We see it in our emails. We just see it in lots of comments. It's just a battleground stock for retail. So it's always interesting to hear someone like yourself who talks to a lot of institutional players, kind of the questions that they're giving you. I think we talked about this last time you were on the pod. I mean, in my career in 25 years, I've just never seen a cult leader of a publicly traded company like a guy like Elon who makes it out of a period kind of unscathed here. And you just mentioned a couple of those things. I mean, 420 and the pedo stuff, those seem like a distant memory. And now I feel like when you think about him not only being the CEO of Tesla, of SpaceX, of Neuralink, of Twitter, of the Boring Company, like this is not a sustainable path for a company that's made a lot of lofty sort of projections, which has gotten, a cult-like following in the investment community. And the point that I would just make is, and you just said it, Ben, I mean, he's got people paying $10,000 or $15,000 for a product on a car that's already much more expensive than many of its peers that doesn't even work. NHTSA has just recalled. You know what I mean? So, like, to me, there's more shoes to drop, in my opinion. I know there's a lot of people who do far more rigorous financial work into this company, and some obviously on the other side of this trade who think there's some shenanigans going on there. But again, we'll see what happens here. But listen, we really appreciate all of that. We appreciate you taking our lobbies here. We want to hit you on the rest of your space really briefly. And again, it must feel very odd to you that probably Tesla in your universe is 90% of the market cap, but you do cover a lot of other names in the sustainable energy space here. Talk to us a little bit about your broader thesis away from Tesla, and maybe a couple of the names that you really like that our listeners should take a look into.
One of the things that I think we've learned from Tesla, I've learned from Tesla, investors have learned from Tesla, is how difficult it is to ramp production. We've seen it with the F-150 most recently, but we've seen it with the Rivian, now perform on Rivian. I like the consumer vehicles. I like their electric delivery van. It takes a lot of capital. It takes a lot of time. And the other OEMs, we've seen it from companies I don't cover, like Fisker, or we've seen it from others that, just the rough ramp in production. It's not just the startups, it's the OEMs. And so I think the big OEMs, for the most part, with some exceptions, are going to have a difficult time, changing their business into electric vehicles and doing it quickly. And we've seen, we've been talking about competition for a long time, and they haven't really done it. It's taken 10 years for them to wake up and start moving in this direction. So that's a number one takeaway. Number two is, the material supply chain. We've seen companies from Tesla to GM to Volkswagen to others move into materials from lithium to rare earths. So I cover a stock, MP Materials. I covered the predecessor, Molycorp. There's a mine out in California, a rare earth mine. These rare earths go into permanent magnets that go into permanent magnet motors. Tesla Analyst Day said, hey, we designed a new motor, a permanent magnet motor, doesn't use any rare earths. I get on my morning call and talk about Tesla and Analyst Day. And you know what? No one cared about that. They all cared about MP Materials, gapping down 10%. I rated an outperform. I think, when Tesla will patent this, I suspect if they're able to do it, and that leaves the rest of the auto industry and the wind turbine industry. But I think materials is an area for investors to focus on because, it is, something that I think was a big part of the Tesla presentation on how to scale to 20 million units. It's going to take, more lithium conversion facility. I cover Albemarle. I have a neutral on it, but they have the largest scale there. Lithium prices have just gone up to the right with a recent little hiccup. And the tough part of it is that regardless of whether Albemarle has long-term contracts, it's going to trade with lithium prices. But if I was going to invest in lithium, that's the one company I would invest in. I think the other thing that's important is that, with the Inflation Reduction Act, we used to have, energy policy. It's been a long time since we've had a comprehensive energy policy. But this takes away a significant overhang in the solar industry about when tax credits are going to get extended or if they're not going to get extended. We like First Solar in that it's had a big run on it on the Inflation Reduction Act, but I think it still has room to go higher because they're differentiated. And as we talk about China and risk, this is the one solar company that doesn't have their supply chain moving through China. And so when their customers, the Dukes, the Southern companies, the Nexteras of the world, are going to build big solar utility plants, they're going to turn to First Solar. They have turned to First Solar, and these guys are booked out through 2026 with some orders in 28 and 29. And only 2 times in my career have I seen solar panel ASPs actually go up. It's happening right now for First Solar. Some catalysts ahead there, and those are the 2 stocks I'd highlight.
There's a scarcity of water. There's infrastructure that needs to be done. Can you just go over that thesis a little bit? I think your top pick there is WTRG, if I'm not mistaken.
I don't cover American Water. It's the largest. I covered it in the past. It's an easy way for people to get exposure to water utilities. I cover some smaller ones, Middlesex Water, which primarily in New Jersey and some in Delaware. Small cap. WTRG, went and bought People's Gas, which is a gas distribution business in Pennsylvania. There's a short report on recently. These are good stocks, water utility stocks, primarily for a market like this. Even with rising interest rates, they've gotten clipped on that. But, like American Water, for example, typically targets 7 to 10% earnings growth per year. And they're a regulated utility, and so they go out and put pipes in the ground. And earn a return on it. California Water, this company I covered, great management. It's a very tough operating environment in California, but people want to own the stock because it's a rare asset of pure play in California primarily.
Well, thanks, Ben Kallo. We really appreciate you coming on and laying out your bullish thesis for Tesla, giving us a little update on what you thought went on at that investor day and giving us a little take on your space in general. So thanks a lot, Ben.
Thank you, guys.
Thanks once again to CME Group, iConnections, and SoFi for sponsoring this episode of On the Tape. If you like what you heard, make sure you hit follow and leave us a review. It helps people find the show, and we love hearing from you. You can also email us at contact@riskreversal.com. Follow and connect with us on Twitter at OnTheTapePod.
On the Tape is a Risk Reversal media production. This podcast is for informational purposes only. All opinions expressed by me, Dan Nathan, Guy Adami, Danny Moses, and any other participants are solely our opinions and should not be relied upon for specific investment decisions.